Assalamu alaikum. Welcome to day 13 of AFM revision crash course. Today we are going to cover business valuation relating to acquisition. So let's start to the topics. We are going to go to the past exam, then we are going to go to an overview of valuation methods. Then we have the three method of valuing business: market based, cash based, and asset based. So let's start with the past exam history. The most common method that is used in the past paper is free cash flow and free cash flow to firm and PE ratio. This two method is very common when it comes to business valuation. Other methods are also there which we need to learn, but they don't come that much compared to this two because lots of workings are required in this two area, especially free cash flow and free cash flow to equity. Okay, and then we have net asset valuation. As you can see, it only came once. Net asset valuation is not so common. Okay, and if you see every year, almost every year it came, every sitting it comes business valuation. You cannot skip this topic. You have to know business valuation. If you don't know business valuation, don't go to do AFM exam. Don't go to the exam hall. Don't even think of giving your AFM exam if you're not thorough with business valuation. Because let me tell you, from my experience and what I have seen from others, most of the students who fail AFM is only because of this area, business valuation. Yes, you have heard me right. Lack of understanding of business valuation, or lack of they are not able to interpret appropriately in the scenario given to them. They get confused which method to use because too much of information is usually is there given on business valuation that you need to read, right? So make sure that you practice enough in this area, business valuation. In your acquisition and merger, this is the very important topic, business valuation. Other things are also there, but mostly business valuation comes at the top priority. Now let us go to the overview of the valuation method. So there are three methods as I told before. One is market based, one is cash based, and one is asset based. And under these three methods also we have uh, different methods, right? So in your exam, remember you have to know the advantages and disadvantages of all these three methods, and the examiner will never tell you which method to use. It's up to you. You have to decide. How will you decide? Based on the facts and the figures given to you. For example, if you are given a cash flow, definitely you have to use a free cash flow, right? You have been given the cash flows, you have been given the cost of equity or WACC. It shows that you have to use free cash flow to equity, or the share price is given to you. That means you have to use a market base, or the net asset value is given to you. That means you have to use asset base. So it depends on the information provided to you in your exam. Okay, so don't go with this misconception that the examiner will tell clearly, so I will use that method. No, any of these three method can come. Okay, but from my experience, it's mostly cash based. Number one, cash based. Number two, market based, and then asset based. Asset based, very rarely, but cash based definitely you have to know the free cash flow to equity and free cash flow to firm. And market based, the PE ratio. These three methods are very common. And in practical world, remember this method that you're using to value the business, right? These are not the actual valuation of business. The value will go up and down. It will change. Why? Because this is just the starting point for negotiation. If you don't value, it's like an estimate only. You just need to know an estimate to know that range, that this is the range where I'm going to start negotiating from. If you don't know that, then how will you negotiate on the price? Then your price will be too high or too low. That's why you need this methods to value your business. So let's start. For further reading, you can go to your ACCA website and read the technical article business valuation to know more details about it. Now let us go to the market base. Under market base, the first method we are going to go is stock market value. Okay, so stock market value, the price is already given. Okay, the stock market value is already given for listed company only. If you are an unlisted company in the scenario given to you, then you cannot use this method. So you have to understand also according to your company what is suitable method to value your business or not. You just cannot use any method. If you are not a listed company, you cannot use stock market, then you have to use asset based or cash based. But listed company can use the stock market value. Okay. So in stock market value, not much adjustment has to be done. like free cash flows and all. You can just take it and you can add a premium to it, right? It's not that the actual price only you pay. Whenever we buy a company, we always pay some amount of premium is required that is above that stock market value in order to acquire controlling interest there. The second method is PE method. Very common method is the second one, PE method. So I'm going to focus on this. And there are formulas that you need to know when you're valuing a company using PE method. So when you want to find the value of equity, you can use this. There is a second method also, but let's start with the first one. Profit after tax into suitable industry PE ratio. This profit after tax can be given to you as it is. They will mention it. Profit after tax is so. Or they will give you some other information where you need to calculate profit after tax. So in both way, you have to know how to use it, okay? Indirectly versus directly. When you have to calculate profit after tax, make sure you know how to calculate profit after tax. For example, they will give you the sales, the cost, the tax, the depreciation, the investment, all those things, okay? And I'm sure that you know how to calculate profit after tax. So I'm not working on that. Next, suitable industry PE ratio. They will give you the PE ratio, okay, of the industry. Some PE ratio they will give you. So that you have to multiply with the profit after tax to find the value of the equity. Or the second method that you can use is EPS into PE ratio. If you want to find the value of a share, one share only. Value of equity means that's whole, the total equity. But value of a share means only one share. You are finding the price of one share only. EPS into suitable PE ratio. Okay. Next. So PE ratio applied should be that of a similar company or industry. You cannot use a PE ratio completely from a different company, because then the PE ratio will be very high or very low depending on the risk of that company, which is not suitable to your company. So you have to see that also, whether that company is similar industry. But in practice, remember, it's very difficult to find such PE ratio because no company will be very similar to you. Maybe their capital structure will be different from you. Maybe their business risk will be different from you. Something will be different from you. So exactly as it is, you cannot take, right? But from your exams point of view, you can take the PE ratio of the similar company, but you have to make sure that you write these limitations, okay? Because for the disadvantages also you need to write something, right? So you have to write these things, because usually what happens that whatever PE ratio you are taking from the similar industry, let's say PE ratio is 20, you will adjust it up or down depending on your company. For example, you have taken a PE ratio of a listed company and you are an unlisted company, definitely you have to bring down your PE ratio from 20 because you are an unlisted company. So your PE ratio will definitely be lower than the listed company. Or if you are the one who is performing better than the other company, the similar industry, then you have to bring up that PE ratio. Okay, so accordingly you have to adjust that PE ratio. Next. The third method under market base is Tobin's cube market to book ratio. This also comes, but not like PE method. Out of all the three, PE method is the most common method. But that does not mean, guys, that you are not going to focus on stock market value or Tobin's Q. Make sure that you know all the method so that whatever comes in the exam, you are prepared for everything. Okay. So market to book ratio. Okay. So this is how you find out the market value of the target company. Market to book ratio. Usually they will give you the ratio. Okay. That ratio will be given to you. And into the book value of the target company's asset. Book value will also be given to you of the target company's asset. So you just multiply and find it. Then so market to book ratio is what? Market capitalization divided by book value of asset, right? That's how you find market to book ratio. Or you can take an industry average also for that ratio. If you're not getting any market based or market capitalization or book value of asset, if they have not mentioned anything, you can take the industry average. Okay. For a comparator company, you have to take companies where you can compare with. Now let us go to the cash based valuation methods. Most common is this. So focus on this and practice on this. Because if you see your past paper, the whole past paper is on this method only. DVM, dividend valuation model. This also comes. So in dividend valuation model, this is the formula. Formula is there in your formula sheet, but Still, I've given it for you. Okay. So if you see the variables in your formula, you will know what are the things you need in your exam scenario. First of all, they will give you the dividend. If they don't give you the dividend, at least they will give the cash flow. Okay, that cash flow so you can use instead of the D0 dividend. Okay, they will give you the cash flow, they will give you the cost of equity, they will give you the growth. So this three variables, if it's given to you, dividend valuation model you have to use. Growth rate, cost of equity, and your cash flow. Another method where you can use to find the growth rate is how sometimes you have to predict that growth rate. They will not give it directly. You can use Gordon's growth model. This formula is also there in your formula sheet. The formula is G equal to BR. G is the growth rate, B is the retention. How much of your earnings are you retaining? Sometimes they will not give you that also directly. They will say you that the dividend paid out is 60%. So that what does it mean? That means your retention is 40%, the balance, right? If you are paying dividend 60 means balance 40 is your earnings that you have retained. So that's how you get the retention rate. Sometimes directly they will give you that this is how much you have retained. So that is that retention you are going to use for B, and R is the rate of return, or you can use cost of equity also. Okay, they might give you one of these two. If it's the rate of return or cost of equity, any of it you can use for R. So multiply both retention rate with the cost of equity or retention rate with the rate of return and get the growth rate and put it there in that model to find the to value your company. This method is also very common in your exam. Then we have what I say discounted free cash flow. This is not free cash flow to equity guys, this is free cash flow to firm. Okay, FCF. I have already made a video on all these models in my YouTube channel. On the playlist you can check. It's there on my YouTube channel. The playlist mergers and accusation, right? AFM lectures on mergers and accusation. That playlist you can go and check. It's in order only: cash based, asset based, and market based. So there you will find this discounted free cash flow, discounted free cash flow to equity. But separate videos also I have for free cash flow and free cash flow to equity. Okay, so you can check this out. Now let us go. So value of the equity. See, business valuation means what? We are only worried about the value of equity only. Okay. So value of equity can be found by discounting free cash flow using WACC. Remember, when it's free cash flow, FCF, there is no E. You have to discount using WACC only, or cash of capital. Okay. Free cash flow will be given and then you discount it using WACC. And then you have to deduct the value of debt because we are only focused about value of equity only. Value of equity is the value of the company only. Okay. All this method that we are using, market based, cash based, asset based, what are we doing? Finding value of equity only. Okay. Because value of equity is only the market valuation. You understanding? So you have to deduct the value of debt. For example, the debt could be a bond, long-term bond, or a long-term loan. They will give you. Okay. You have to deduct it. Don't forget to deduct it. But when it's a free cash flow to equity, this is the third method under cash based. Then this is the formula. If you see this formula is very similar to your dividend valuation model, just go up and check. The only thing that is replaced, instead of D0, it is now FCFE0. So they will give you the free cash flow to equity. They will give you the growth rate. They will give you the cost of equity. Okay. When you discount this, so this you have to find out like this. You will be given the cost of equity. Okay. Here, this is a pro forma to calculate free cash flow. To calculate free cash flow to firm from profit. Very important. Sometimes they will give you the profit. They might not give you free cash flow to firm. But you need free cash flow to firm only to value the company. Then how do you do it? You have to go, right? You have to go backwards. So you first start with profit. This is a pro forma that you can use. You start with profit before interest and tax. Then you deduct your tax from it. Because tax is a cash expense. Anything which is you are paying in cash, you deduct it. Because free cash flow to firm is what? Simply cash. Okay, so from profit, you are now changing that profit to cash. That's what it means. So deduct tax. Then we have depreciation you have to add back. Why? It's a non-cash expense. You have deducted depreciation when you were calculating profit, but now we want to convert it into cash flow. So add depreciation back. operating cash flow. So after you add your depreciation, you will get an operating cash flow. Then less all your investments, because for investment you have to pay in cash. So first investment is replacement non-current asset. For example, you are replacing a non-current asset, right? Then you have to deduct. Or you are buying more non-current asset now, incremental non-current asset, deduct. Or working capital, you are increasing your working capital, deduct. So these three things you need to deduct. After that, you will be having what is left, that is known as free cash flow to firm as a whole. Okay. Then you have to deduct your debt, interest, and repayment. Remember, this is free cash flow to firm as a whole. You want to find the value of the company, free cash flow to equity. Okay. So you have to deduct your debt, interest, and repayment also, and then you have to add any cash that is raised from debt issues. Sometimes it happens, right? If you have taken a long-term loan, then you have to add it because that is cash raised. Your cash is increasing from it. Then what is left is known as free cash flow to equity. So make sure that you know this method of doing it, because sometimes they might not give you the free cash flow to equity directly as it is, but if you're lucky, they might give you. But most of the time, guys, some adjustments are required. Not this lengthy, but one or two adjustments are required to find this free cash flow to equity. Now, what are you going to see through this? The trend over a period of years can be taken as an indication of the future. Yes. Sometimes the trend, you see the trend of free cash flow to equity. If you see it's increasing for 4 years, you have been given the free cash flow to equity. It suggests that in the future also is going to increase. Second, note that KE, okay, can be used to discount free cash flow to equity. So when we are discounting free cash flow to equity, we are taking cost of equity, not WACC. WACC we are taking only in free cash flow to firm. You need to know these two differences. So when you discount the free cash flow to equity using cost of equity, you get the value of the equity directly. No need to deduct it from debt or anything. Okay. But if you are using free cash flow to firm, then you discount using WACC and then deduct debt value and find the equity value. So there are two methods. And sometimes, how do you know free cash flow to firm or free cash flow to equity? It is simple. See in your scenario, did they give you WACC? Or did they give you cost of equity? Sometimes they will only give you cost of equity and free cash flow to equity. So it's directly you know that discount using free cash flow to equity, you discount using cost of equity and find out. Sometimes they will give you WACC. So that shows you have to use free cash flow to firm. Sometimes they will give you cost of equity and free cash flow to firm, but you cannot use cost of equity to discount free cash flow to firm. What do you have to do? You have to find WACC through that cost of equity and then discount it. Or you have to find the free cash flow to equity from free cash flow to firm. Okay, so make sure that you know all the scenarios. Okay, any of it is possible. Now let us go to the asset based, the third type. So under asset based, we are going to go through basic asset valuation. Directly you can take from a balance sheet, right? This is the value of the asset. So for asset, you can take the book value from the statement of financial position, or their replacement cost, or their net realizable value. Okay, to get the value. Then, but in all these cases, when you are taking the basic asset valuation, you are ignoring any intangible asset. You are not taking the value of intangible asset, only tangible asset. So the second method, because intangible asset is ignored, it does not give you the true value of the company. Now you are including intangible also. So for that, you need to value the intangible, right? Intangible valuation. So because of that, total value is simple. Whatever the asset value that you get plus the intangible asset value. That's the total value. So the main way how you can find the value of the intangible is through this calculated intangible value. And there's a formula for that. So let us go to that formula. So the formula is this. First you start with finding return on assets. You have to find a return on assets. How do you find return on assets? Operating profit divided by asset employed. Or you can use the industry average return. Either you find it if they have given to you operating profit and asset employed. If they have not given you anything, they will give you the industry average return, that you have to use it first. Second, find the value spread. company's value spread. So for finding the company's value spread, the formula is operating profit minus whatever the return on asset you have taken. Right? Maybe you have found it out using operating profit divided by asset employed, or you have taken the industry average, whatever it is, multiply by the company's asset base, whatever the company's asset is, and deduct it from the operating profit and find the value spread. Third step is, this is on the other next page, okay? Because I don't have space there to include it, so it's on the next page. That's the third step. You first find the post-tax value spread. So that this value spread, right, that you have found out, now you have to find after tax. Then you have to use a growth rate. They will give you the growth rate. Okay. So then to find after the growth rate, what is the expected post-tax value spread? Okay. And then find the calculated intangible value by capitalizing the post-tax value spread. How do you capitalize it? So whatever the post-tax value spread you have got now, you have to capitalize it. And that will be your calculated intangible value only. Okay. Then finally, you get it, and then that you add with your net asset value, the CIV, and you get the overall value of the firm. So that's it, guys. We have completed business valuation, and tomorrow the last topic, day 14, reconstruction. Right? So we'll see you there. Until then, take care.